Hello students. In this video, we are going to learn about the meaning of general insurance, a brief history about general insurance, and what are the various basic principles of general insurance. So let us start. Let's understand the concept of general insurance. See, we know that every person who is earning the income by putting his hard effort and hard work, they are making their own properties, they are making their own assets, and everybody wants that their assets should be secured against the any kind of difficulties or problem. For example, I have purchased one house or I purchased some material, and there are chances that I may lose those material or my house due to some reason. That reason may be the natural calamity or anything which may damage my property. And this property has been made up by me by putting lot of efforts. So I just want to ensure myself that my property is not getting lost. So I cannot control the natural calamities, but what I can do, I can get insurance on my assets, and then insurance company will be taking the responsibility of my asset. That means if anything will happen to my asset, if I'm losing those assets, then it will be the insurance company which will be taking care of those loss, and they will pay the compensation to me. So that is called as general insurance. Now, this general insurance concept is not the very new concept or the recent concept, but it has been discovered years back, even in the ancient time, when human beings started learning how to live a settled life. From those days onwards, the concept of general insurance was common. Even in our Rig Veda has mentioned about the term Yogekshama, which means the security, prosperity, and well-being of the society. And that is only because of general insurance. In those days, of course, insurance companies were not there, but these were the neighbors or the society who used to help the person or the family, those who are losing the assets due to natural calamities like storm or drought or any other thing. So human being wanted the secured life against his assets. And slowly, with the passage of time, when we started learning about the concept more and more, the concept of insurance companies came. So whenever we want to get insurance on our asset, that insurance is called as general insurance. Now let us understand what is the definition of general insurance. General insurance is nothing but it is an agreement between client and the insurance company for the loss of any asset resulting into economic loss against the payment of premium is called as general insurance. So here the client, that means the person who wants to get his property secured, wants to get insurance from the insurance company. So he is the client who is getting insurance company's promise that if anything happens or there will be any kind of loss of asset, it will be borne by insurance company. And against that, that means whatever promises insurance company is making to the client, against that, insurance company wants the payment of insurance or premium. Payment of premium. Premium means any amount which is paid by client yearly or on the fixed period of time. So this premium will be the consideration or profit for insurance company, and for that particular period, insurance company will be taking the responsibility of the assets of the client. So from this definition, few characteristics are derived. Number one characteristic is it is an agreement. It is an agreement because both the parties, that is client and insurance. Now in this case, client will be called as insured, right? The term insured is applied for the term client, and insurance company will be called as insurer because they are promising that they will be providing the compensation for the loss of asset. So client will be known as insured and insurance company will be called as insurer. So there are two parties. One is called as insured, who is the client, and another one is insurer. Insurer means the insurance company which is giving the charge, or which is giving the promise that the property will be protected from any kind of loss. So if there is any kind of economic loss to the client, it will be the insurer who will be making payment of that loss to insured. Then the another thing which we are understanding from this definition, it is that protection from loss of property. 100% this agreement is for that purpose only. The insured, that the client is getting protection from the loss of the property. And the last one is consideration. Consideration is in the form of premium. As I told you, that client have to pay a periodic payment to insurance company against the safety and security of his asset, and that will be called as premium. This premium may be quarterly, it may be half yearly, or it may be yearly or annual. Sometimes insurance companies are charging even the lump sum premium. So, it depends upon the type of insurance which you are taking and the type of asset which you want to get insured. So these are the basic characteristics of the definition which we have learned from this. Now, let us move to understand regarding the history of general insurance. That means from when we have got the importance or understanding of general insurance. As I told you, general insurance is not the very new concept. It was there even in our ancient time, and our ancestors also were using this particular concept. But officially, how this particular concept was popularized, this particular concept of insurance has been passed through 3 phases. Phase 1 was British period. It was the period when Bharat was ruled by Britishers. Then another one is post-independence period. This is the period from 1947 onwards. And the modern phase. That means in the current era, in the current time, what is the position of general insurance? Now let us understand about the general insurance during the British era. Now this British era or the British period was a period when Bharat was ruled by Britishers. Now here what had happened, in the year 1850, there was one company called as Triton Insurance Company, which started its business of insurance in Bharat. So we can say that 1850 was the official period when general insurance concept was popular. Now, apart from that, in the year 1907, even this was the period which comes under British period. It was the period when IMIL, that is Indian Mercantile Insurance Limited, it was there to control these insurance companies. So we can say that from this particular period, that is 1907, this general insurance company got recognition and even they got the controlling authority. So we can say from this particular period, or before that also, the concept of general insurance got popularized among the people, and people started getting protection against their property. So this is all about the British period. Now let us understand what had happened in the post-independence period. Now post-independence period is the era when Bharat got independence from the rule of Britishers. Now here I would like to give focus on 2-3 years. One was the year 1957. Here we got the establishment of GIC. GIC stands for General Insurance Corporation. In 1957, when the second 5-year plan of Bharat was implemented, there was establishment of GIC, and it was a remarkable change in the insurance market in Bharat in post-independence period. So that was the year 1957. Then again in the year 1968, the Insurance Act was amended. So here we can say that it was a period when the Insurance Act was amended. After that, 1968, again in the year 1973, the enactment of General Insurance Business Act was passed. Again, after 1973, in 1990s, there was the holding of private sectors also in the field of general insurance. So these are the four basic years which you have to keep in mind when you are preparing for post-independence period. Now, after that, we had the concept of IRDA. IRDA stands with Insurance Regulatory and Development Authority. It is the autonomous body which is taking care of all the rules and regulations which are supposed to be followed by all general insurance companies, because 1990s was the period when Bharat have allowed all the private companies to do the business of general insurance. So there was a need for all these things. So you have to keep all these years in your mind when you are preparing for post independence period. Now let us move and let us understand what had happened, or what is the impact of these two phases on modern phase. In modern Bharat, people know the importance of general insurance in their lives. They know that which policy will make them insured from uncertain risk and how they can protect their future from contingencies. With the passage of time, the number of general insurance company is increasing with the greater number of clients for it. Even banks also have extended their services from just banking to insurance. So modern phase is the phase which is going on, and here we are having most important role which is played by general insurance in our lives. So everyone wants the protection for their assets. Now this is all about the brief history of the general insurance in Bharat. Now let us understand that when the agreement is happening between the two parties, these two parties are insured and insurer, what kind of principles they should follow. That means what kind of rules they should have, and what are the things which they should keep in mind when they are entering into the general insurance. The first principle says there should be principle of utmost good faith, because both the parties are entering into the contract where one party is promising that they will protect the asset, and if anything happens to their asset, they will be taking the loss responsibility. So over here, this principle says that the insured, that means a client, have to declare each and everything to the insurer. If I am the client, if I want to get protection on my asset, and I already know that my assets are suffering from some defect or some problem, so it is my moral duty, or it is my job, to inform to the insurer or the insurance company that, see, this is a situation, this is the value of my asset, and this is the problem with my asset. So there should be transparency. I should not hide anything from insurance company. Similar way, when insurance company is taking the charge, when they are taking signature of the client, they should explain each and everything to the client. There should not be any kind of hidden cost. There should not be any kind of hidden rules which are to be borne by the client when the actual loss is going to happen, right? If anything is happening, loss is happening, and if the client is approaching to the insurance company, and let us say insurance company saying that, no, sir, this is not the loss which you are going to, bear it. This was there in our paper, and you have signed that. No, this thing will not be tolerated at all. All the insurance companies have to inform very clearly about the terms and conditions, about the policy to the client, and at the same time client also should explain each and everything about the product or about the goods to the insurer. So there should be utmost good faith from both the parties. The second principle says that principle of insurable interest. That means the contract of insurance requires this particular principle in the subject matter. Why? Because the presence of the subject matter will benefit the insured financially, and the non-existence of such a matter will make the insured suffer from financial loss. For example, Mr. A has taken one insurance policy for his goods, which are the subject matter, lying in the godown. In this case, Mr. A has an insurable interest in the goods, as the presence of goods will make him to earn profit, and if he sells goods in the market, and if the goods are destroyed by any reason, will make him to suffer from financial losses. So there should be insurable interest from the side of the client. Then the third principle says that principle of indemnity. Indemnity simple meaning is guarantee. In case of insurance, the insurer is giving the guarantee to the insured that if the insured is suffering from any kind of loss of the goods or subject matter of the policy, then that loss will be borne by the insured through settlement of claim, and that is called as principle of indemnity. Here the guarantee is given from insured to from the insurer to the insured. Then the next principle is principle of subrogation. Subrogation means ownership. Now over here, this point we can understand with one example. Let us say Mr. A has taken one insurance policy for his car, right? Car is the property of Mr. A, and Mr. A has taken one policy on car, and insurance company have promised him that if anything is happening to his car, if the car is getting lost or theft or stolen, then insurance company will give him the compensation for the car. Okay. Now, one fine day, what had happened? The car was stolen. Now, Mr. A was having, the insurance policy against the car. What he has done, he went to insurance company and he showed all the documents, he showed all the proofs, and he proved that the car was stolen. Then insurance company, what they have done, they have accepted his claim and paid the amount of the policy to Mr. A. Now, the matter was closed. But after few days, the car was found. Right now, over here, the confusion will come that who will be the owner of the car now. Mr. A has lost it and he claimed it from insurance company. Now the car has come. So over here, the principle of subrogation will work. Principle of subrogation says that if any goods which are recovered even after settlement of the claim will become the property of insurance company or of the insurer, not of the insured. That is called as principle of subrogation. Then the next principle is principle of contribution. Contribution means something in return or some benefit. Now here, when two parties are entering into the agreement, that is the insured and insurer, both of them are having the benefit. Both of them are having support. Insured is getting promised that if his goods are getting lost, then insurance company will pay the compensation. And against that, the insured is making the payment of premium periodically. So both are getting the benefit out of this particular agreement. Now let us understand the next principle. The next principle is principle of mitigation of loss. This particular principle implies that the insured must try to minimize the loss of risk of the goods which are subject matter of the policy. That means when the insured or the client, when he is getting the goods insured, he should not think that now he has taken the policy, now there is no need for him to take care of the goods. If the goods are getting lost, then it is an insurance company which is going to make payment to him. That is the wrong thing, right? There should be mitigation. The system should be there, right? The client should take the utmost care of the goods. And even after taking utmost care of the goods, even after that the goods are getting lost, then only insurance company will come into the picture. So when, as a client, when you are taking the insurance on your goods, does not mean that you are relieved from, taking care of the goods. It is your job to take care of the goods. That is called as principle of mitigation of loss. Then the next principle is principle of causa proxima. The principle states that if the loss happens due to more than one cause, then proximate cause of loss is to be found and considered to decide about the liability of the insurer. The insurance is given by the insurer for the loss due to some specific causes and not for all the causes. Hence, the causes for which the insurer has taken the responsibility is called proximate cause. An insurer is liable only for that cause. So these are the basic 7 principles of general insurance. I hope you have understood this particular topic very well. We will continue with understanding the concept of regarding what are the various general insurances in our next video. Thank you.